Imagine owning a global food empire. When global food prices skyrocket and farmers lose everything to climate disaster, one shadowy industry isn't mourning. They're celebrating record profits. While the world fears a bread shortage, agribusiness giants like Cargill are weaponizing that exact instability. They've turned systemic chaos into a risk managed goldmine by controlling the very infrastructure of survival. That's the pitch, and a lot of it holds up. But the actual mechanism is stranger than evil corporation profits from hunger, and once you see it, you can't unsee it. Because these companies do not make money when food is expensive. They make money when food is confusing. Stability is the thing that nearly killed them. Let me show you the machine. Part 1. The mechanics of profitable chaos. Start with what a food empire actually sells, because it isn't food. Economist Craig Pirrong describes the business as transformation, moving a commodity across space, holding it across time, and changing its form. Here's his textbook example. You buy corn in Iowa at $5 a bushel. You find a buyer in Taiwan paying $6.25. In between, you pay for elevation onto a barge freight, transfer to an ocean vessel, ocean freight, financing the cargo while it floats, and insurance. Total cost, $1.15. Your margin is 10 cents a bushel. 10 cents. That's the empire. Now scale it. Cargill's revenue hit a record $165 billion by mid-2022, and in that same record year, it earned net income of about $6.69 billion. Run the math, roughly 4 cents of profit per dollar of revenue. That's a supermarket margin on a business that moves an ocean. So if you thought you were buying fat markups, no. You're buying a toll booth on a river, paid in pennies, millions of times a day. Which means your enemy isn't a high price or a low price. It's a price that moves while your corn is floating. As journalist Javier Blas puts it, commodity traders are arbitrageurs above all, largely indifferent to whether prices rise or fall, because what they harvest is the disparity between locations, grades, and delivery dates. Read that again. The empire isn't long food, it's long dislocation. And here's the proof. And it's the part nobody covers. Watch what happened when the world got calm. Cargill's profit fell 43% to $3.81 billion in the fiscal year after the record. Revenue dropped almost 10% to $160 billion in fiscal 2024 as commodity prices collapsed under a global crop glut. By fiscal 2025, revenue was $154 billion, the lowest since 2021, and the company had cut roughly 8,000 jobs, about 5% of its workforce, and collapsed 5 business units into 3. ADM announced it would cut 600 to 700 jobs and strip $500 to $750 million of cost as soybean, corn, and wheat prices fell to their lowest since 2020. Bunge warned 2025 earnings could sink to the lowest in 6 years. Nothing was wrong. That was the problem. Huge harvests, full warehouses, predictable prices, narrow spreads. A boring world is the one environment where a toll booth stops collecting. So when you hear these firms profit from chaos, understand it precisely. They don't need prices high, they need prices unstable, and abundance almost broke them. Now flip it. 2022. Russia invades Ukraine. 2 of the planet's biggest exporters go dark, and the FAO Food Price Index spikes to an all-time record in March. Every route, every grade, every delivery date is suddenly mispriced against every other one. Cargill posted its best year ever. ADM posted the highest profits in its history. And research by the Dutch group Somo found that in 2022, the profits of the 5 largest agricultural traders tripled compared with the 2016 to 2020 period. Why them and not you? 2 moats. First, physical. Cargill Ocean Transportation charters a fleet of about 640 vessels, moving more than 1 million metric tons of agricultural commodities every week. And those ships make over 6,000 port calls a year, carrying more than 200 million tons of dry bulk. Elevators, river terminals, crush plants, port berths, assets that took a century to assemble and sit in places with room for exactly one. Second, information. When you buy from tens of thousands of individual farmers, you learn the size of the harvest before any government agency publishes it. And this isn't theory, it's the founding trauma of the modern grain trade. In 1972, Soviet crops failed, and Moscow went quietly shopping. Over July and August, the Soviets contracted for about 440 million bushels of American wheat, roughly $700 million worth, negotiated privately with U.S. exporters, and supported by a government credit line of up to 750 million. By the time Washington understood the scale, a substantial share of American reserves was gone, and about a year later, some commodity prices had doubled or tripled. They called it the Great Grain Robbery. Congress responded by mandating an export sales reporting system in 1973. The lesson wasn't about Russia. It was that private traders saw the shortage before the United States government did. That is the asset, and it keeps concentrating. ADM, Bunge, COFCO, Cargill, and Louis Dreyfus together control between 70 and 90% of the global trade in commercial grains, are deeply vertically integrated, and collect enormous amounts of data on harvests, prices, and political developments everywhere. Then on July 2nd, 2025, Bunge closed its $8.2 billion merger with Viterra, creating a company that operates more than 300 grain storage facilities, over 40 port terminals, and more than 155 processing plants, with more than 50,000 employees and revenues north of $100 billion. Part 2. The 2026 landscape and how black swans became line items. Here's what's on the board right now, in July 2026. Start with weather. A strong El Niño was declared in June 2026, forecast to peak over the Southern Hemisphere's planting season. In Australia, severe dryness in New South Wales and Queensland had already forced farmers to scale back wheat and canola planting, with the USDA forecasting lower wheat and barley production and exports, while cattle producers sold animals in record numbers ahead of the dry outlook. That matters more than it sounds, because Australia grows only about 3% of the world's wheat, but accounts for 10 to 15% of world wheat trade. And in past El Niño years, its harvest fell 46% in 1982, 46% in 1994, and 36% in 2023. Then geopolitics, layered on top. Shipping through the Strait of Hormuz has effectively stalled since late February, with transits down more than 95%. UNTAD warns the full economic impact may not be clear until the second half of 2026, and notes that roughly a third of global seaborne fertilizer trade moves through that strait, raising the risk that prolonged disruption pushes up agricultural production costs by limiting fertilizer access, with Sudan already in a food crisis, receiving 54% of its fertilizer from Gulf seaborne imports. Vessels are rerouting around the Cape of Good Hope, adding 10 to 20 days and spiking ocean freight rates by up to 50% for U.S. importers. Now here's the part that shows you how the machine actually thinks. Despite all of that, the FAO Food Price Index averaged 130.3 points in June 2026, down slightly from May, and FAO forecasts 2026 cereal production to be the second highest in history. The index sits about 20% below its March 2022 record. Wheat prices fell 4.4% in June on strong Black Sea harvest prospects, a decline tempered by dry weather and high fertilizer prices in Australia and the United States. Meanwhile, the vegetable oil index rose 7% in a single month to 23.3% above a year earlier. That is not a food shortage. That is dispersion. One commodity collapsing while another rips, freight repricing globally, fertilizer decoupling from energy, and nobody able to see 3 months ahead. To a farmer, that's terror. To an arbitrageur, that's inventory. And if you want the cleanest possible illustration of chaos paying in both directions, look at cocoa. 2 straight below-average West African harvests drove futures to multi-decade highs, briefly over $10 a kilogram in early 2025. Then, by April 2026, cocoa was trading around $3,100 a ton, near the lowest since May 2023, as a bumper Ivorian crop and rising inventories crushed the market. The World Bank now expects prices to fall more than 50% across 2026, with output more than a third higher than last year, while warning that a stronger than expected El Niño could tighten supply all over again. Same crop, 18 months. Catastrophic shortage to glut. And remember, Ivory Coast and Ghana together supply more than 60% of the world's cocoa beans. So both moves landed on the same farmers First as a spike they mostly didn't capture, then as a collapse they absolutely ate. So how do you bake a black swan into a business model? You stop forecasting and start hedging. You diversify across both hemispheres, so a failed harvest in one is a bumper crop in the other. You run a freight desk, so a rerouted ocean is a revenue line. You sell risk management as a product to everyone downstream. UNTAD went further, describing these firms as semi-financial players. 1 foot in physical commodities, 1 foot in leveraged finance, performing what amounts to an unregulated shadow banking function. You can watch this in real time. In its first quarter of 2026, Bunge's GAAP earnings fell 66% on mark-to-market timing, while management raised full-year guidance by nearly 20%, with the CEO openly describing limited forward visibility, shifting trade flows, and customers buying spot rather than booking contracts. Raising guidance into an environment you admit you can't see is only rational if uncertainty itself is the product. But be fair, chaos isn't free money. Bunge's grain merchandising volumes rose over 200%, while profits fell 26%, with management citing weaker ocean freight results, and the Cape of Good Hope reroute added roughly $1 million in fuel per voyage while tying up chartered vessels longer. Chaos pays whoever is positioned. Positioning is exactly what a century of concrete and credit lines buys you. And the structural trend is one direction. A 2025 study in Nature found that even after accounting for how real farmers adapt, global yields of calories from staple crops in a high-emissions future would be about 24% lower in 2100, with today's breadbaskets among the hardest hit. Research led by Maximilian Kotz documented weather between 2022 and 2024 so extreme it exceeded all pre-2020 precedent, with vegetable prices up 80% in California and Arizona, cabbage up 70% in South Korea after a heat wave, and European olive oil up 50% after drought in Italy and Spain. Every one of those is a ruined grower. Every one is also a spread. Part 3. The paradox. Here's where it gets uncomfortable. An estimated 673 million people faced hunger in 2024, and about 2.3 billion experienced moderate or severe food insecurity, while 2.6 billion could not afford a healthy diet, and food price inflation has consistently outpaced overall inflation since 2020. Meanwhile, in 2024, U.S. farms received 11.8 cents of every dollar Americans spent on domestically produced food. The other 88.2 cents went to transporting, processing, and selling it. The farmer takes the weather, the debt, and the land, and about a ninth of the money. It also draws lawsuits. In the INRI cattle and beef antitrust litigation, plaintiffs allege Cargill, JBS, Tyson, and National Beef conspired to limit supply and inflate beef prices, noting the defendants sold roughly 80% of fresh and frozen beef and controlled around 85% of U.S. cattle processing. Tyson and Cargill settled for a combined $87.5 million, granted final approval in May 2026. Both deny wrongdoing. No court has ruled anyone acted unlawfully, and JBS and National Beef have not settled. For a company that once earned $6.69 billion in a year, $32.5 million is a rounding error. And who collects? At least 100 members of the Cargill-Macmillan family together own an estimated 88% of the company, and by Forbes' count, 21 of them are billionaires. In the year ended May 31, 2025, Cargill paid out almost $1.5 billion to its family owners, a record, eclipsing even the payout in the record profit year of 2022. And because it's private, it doesn't have to tell you any of it. As Olivier de Schutter argued, global grain markets are more concentrated than energy markets and less transparent, with no mechanism to force these companies to disclose their holdings or release stocks in time. Now the steel man, because it's real. 4 cents on the dollar isn't gouging. These firms move food from surplus to deficit faster than any government ever has, and they absorb price risk that would bankrupt a farmer in a season. Both things are true at once. A system can be efficient and still be arranged so the people who bear the weather bear the losses. And that's the paradox in one sentence. In April 2026, Reuters reported Bunge lifting its outlook on strong crush margins and biofuel demand. A rally marking a turnaround for Bunge, ADM, and Cargill after a grains glut and trade disruptions had depressed earnings. The middlemen recovered in the same season fertilizer became a weapon and the fields went dry. Nobody in Minnetonka is praying for a drought. They don't have to. They built a machine that converts the world's worst days into a spread, and whose worst year on record was the year the harvest was too good. That's not villainy. It's an incentive structure, and incentive structures outlive villains. The fixes on the table are unglamorous. Mandatory disclosure of physical stock holdings, real merger scrutiny, and public market intelligence good enough that governments aren't the last to know, like they were in 1972. If this changed how you look at your grocery receipt, leave a like, subscribe, and comment below which business you want me to cover next.